back on Morning Movers. Banks may be in the earnings spotlight today, but next week we'll get a closer look at the travel sector when United Airlines reports. Earnings come out on Tuesday after the closing bell. Keep in mind, shares of United down 35% so far in 2025. Now, Delta reported earnings earlier this week and pulled guidance for the full year. We'll see if United follows that playbook. Time now for Options Corner. Joining us to take a deeper look at United's Rick Ducat, lead market technician here on Schwab Network. All right, Rick, let's talk about the trends on the chart for United Airlines, especially when you take into perspective the difficulties it had this year, but it was in the top 3 performers of the S&P 500 last year.
Yes, quite a big turnaround for this name here. You can see how extreme its movement was relative to not only its peers in the JETS ETF, but also the S&P 500, but now kind of retreating back to the mean a little bit, still up significantly, but a rather difficult situation here. My touch screen is not progressing here, so I'll just say as well that we can see that when we have a situation like this, volatility can cut both ways. You can have the big swing to the upside, and then you have to be kind of prepared for it to potentially come back down to earth here. Now you can see as well that when we do have our candle chart up, we have been traveling in a downward channel type of situation here. We broke through all 3 of our moving averages that we follow. Yellow 21-day, orange 63-day, purple 252-day, exponential moving averages. They're all kind of together here. Particularly our yellow and purple 21 and 252 near about 70, 71, which also coincides with our trend line there. So that would be the point to be looking at for a potential breakout. We saw heavy volume yesterday during that big spike to the upside, or 2 days ago rather, during that big spike to the upside here. And also a little bit of bullish divergence on the RSI, which has now crossed out of the oversold area as well. So kind of an interesting setup here in this name, Diane.
All right, interesting setup in the name. Thanks a ton, Rick, for a breakdown on the chart on United. Now to take us through an example trade, we've got Tom White, senior options contributor and co-host of Fast Market. So, Tom, how would you approach this, especially if we, take in the perspective that we have earnings from United next week, and we got Delta this week, but Delta pulled guidance. So, it begs the question, will United do the same thing? So how would you structure an example trade?
Yeah, I think you start taking a look at implied volatility levels going into that earnings report. You take a look at what happened with Delta, maybe a little bit of a reprieve, a little bit of a bounce higher based on the fact that the stocks have pulled back so significantly. United Airlines down over 45% from those all-time highs that we saw just over 2 months ago. So as Rick showed on the charts, it's been a precipitous move to the downside here in there. But IV percentile rank about 97%. So we're in the top, basically 3% of implied volatility levels that we've seen over the last 52 weeks. So that gives you some opportunities here. Now, if you think that you may be United Airlines, which got a nice pop on the back of the Delta rally, if you think United's going to do that same thing, we've got a trade that sets up well with it. It's a 4-legged custom spread, so a little bit more complex than we typically talk about, but you're taking advantage of high implied volatility levels. So going out to the April 17th monthly options that expire in just 6 days. You're going to capture that earnings event on Tuesday after the close. We're going to sell an out-of-the-money put vertical. That's neutral to bullish, right? This is one part of the strategy. Sell the 60 puts, buy the 55 strike puts. It's still risk-defined, selling a $5 wide short put vertical. You're going to collect a credit on that. Now, we're going to use that credit to help finance the purchase of an upside call calendar to take advantage of volatility dispersion on this. So we're going to go out to the 68 strike call. We're going to buy that in the April 25th weekly options that expires in 2 weeks. And then we're in the near term, April 17th options that'll capture that earnings and has the higher IV rate. We're going to sell that same 68 strike call. So just a 1 week wide call calendar to the upside on this. Now that's slightly bullish, right? You can see here from the risk profile, if I pay as a package a 30-cent credit for it, so I'm buying a call calendar, offsetting some of the costs by selling that downside put vertical, you're going to collect a credit of 30 cents. So what does that mean? Well, it takes my break even where I start to lose money down to $59.70. So over a 5% cushion to the downside from the current price of about $63 a share. But you can see here from the risk profile, because I collected a credit, I've only got one break even. Everything above that's going to be profitability. Apex of profitability at or near that 68 strike calendar spread that we did that's 1 week wide. So the idea here is you come out with earnings, the stock goes up about that one standard deviation that the option market's pricing in, about plus or minus 7%. And this takes advantage of it. But you're using the short put vertical that has the higher implied volatility to offset some of the costs on the bullish call calendar. But definitely you need the stock to move higher. But even if it just kind of stays around the 63 level, you're still going to be profitable in this type of trade.
All right, that's an example trade for United Airlines ahead of its earnings next week. Thanks a ton for that, Tom. United's got earnings due on April 15th, the same day that your taxes are due if you haven't filed them yet.